Joined by Nilesh Shetty at this hour, portfolio manager at Quantum Advisor. Nilesh, great having you. Let me first start off by what your outlook is with regard to all the uncertainty that's playing out. Do you buy this uncertainty?
Yeah, I mean, we were actually quite bullish till this Middle East war broke out. Now we are a bit more cautious. Now, India, of course, has very deep linkages with the Middle East, uh, including crude, including fertilizers, including remittances. Last decade, India has not had to worry about crude oil prices, especially after Mr. Modi came into power the first time. Oil prices have been benign, which has allowed India to slowly sort of grow at its own pace without having to worry about the CAD and its implications on the rupee as well as interest rates and inflation, which may change if this war prolongs. We are already seeing some impact of that on gas supplies to industries. And whatever the low inflation numbers that we are seeing, including low interest rates, that may reverse. If that war prolongs, then you see a continued impact on oil supply. So that is a big worry for India. But apart from that, excluding that, most of the things were lining up for India, including increase in sort of consumption post the GST cut, low inflation, low interest rates. So there is significant upside in the markets, barring this issue. Once this issue resolves, you will see the markets bounce back.
Okay. And do you expect a prolonged pain? What are your expectations? What are you really penciling in?
Yeah, I think at least the correction in the market is been not much, 3-4% correction, which may not be the case. It may be a bit more longer than what the market thinks. So at least our senses will be a bit more longer than what the market thinks, but how long, I have no idea. I think markets may have some negative surprises as we go forward in terms of geopolitics of this war.
Speaking of it, Nilesh, are you advising your investors, your customers to buy this dip at this point or wait and watch?
No, so before the war broke out, we were actually asking
Correct.
our clients to be overweight India and overweight equities in general. But right now, we ask them to hold back just to see how things settle because of this war. So we've actually gone back to a slightly cautious stand, asking people to wait and watch. And if the things settle, then it's a good time to allocate more to India.
Interesting. Okay. And Nilesh, in terms of a sector tilt, now we've seen some moves, some very choppy moves in certain sectors. What is it that you would buy at this point, if at all there is any?
Yeah, so we continue to have large weights in financials, in private sector banks. We have been adding into IT services. It is one of the sort of lowest valuations. We've seen them probably now matching COVID lows in terms of valuation at 4-5% dividend yield with the kind of cash flow that they generate. We think we are a very good, attractive option to add to your portfolios, and we've been adding there in the portfolio.
Okay. And talk to us about what you're absolutely not touching currently. What would you absolutely avoid? Would it be export facing? Would it be more with a Middle East tilt, or would it be something completely different?
So it's primarily valuation driven, but we do not have any allocation to industrials in terms of capital goods in the portfolio. I mean, they were rivaling consumer staple valuations before this correction, but they're still not attractive enough. We've not had any allocation to consumer staples for, I think, last 12 years now. Again, primarily on valuations at 70 times, 80 times earnings. Despite the underperformance of the last 3 years where valuations have corrected, they still look quite expensive to us.
Okay. And Nilesh, I know you spoke about IT. Give us a sense on what's driving your thesis with regard to IT.
Yeah, so there is this hype cycle of AI, and there is what is happening on the ground. When we meet a lot of corporations, including consultants on the IT side, the reaction of the market has been quite severe to what is actually unfolding on the ground. In our view, it is unlikely that corporates are going to rip out their existing IT infrastructure and put in an AI coded software. It just enterprises don't work like that. There is a maintenance cycle, there's an upgrade cycle in an AI coded software that is just not possible. So our sense is there is a big overreaction in the market because of this hype of AI. I think enterprises, as they start increasing the adoption, it is primarily IT services companies, including Indian IT services companies, that will help them integrate AI into their existing software. And I think there'll be a bigger opportunity. There will be productivity gains which have to be passed on to employers, to enterprises. But I think on the margin, the pool of offering and opportunity will expand and not shrink for Indian IT services companies.
Understood. Nilesh, thanks so much for joining us this afternoon, giving us that perspective. We'll let you go on that note.
Thank you.
Okay, and viewers, what we'll do is we'll sit on a very short break. We'll continue coverage on the other side. Stay with us.